Portfolio diversification. In investing, we often hear the phrase, "Don't put all your eggs in one basket." Putting all your eggs in one basket is like investing every cent in one asset. You will lose all your money if that asset value falls to zero. In contrast, if you buy a portfolio that invests in a few assets, you will still have some value if one asset fails. Investing in many assets is an important concept called diversification. It helps to reduce your risk. There are two ways to diversify. First, we can invest in multiple asset classes. Second, within each asset class, we can invest in multiple assets. How does diversification reduce risk? The key is in the correlation between the asset classes or assets. Let's understand correlation through a non-finance example. On rainy days, sales of umbrellas go up. Therefore, rain and umbrella sales are positively correlated. In finance, when assets A and B are positively correlated, their returns move together in the same direction. Both assets will lose value or gain value together. When they are negatively correlated, their returns move in opposite directions. A loss in one asset can be compensated by a gain in the second asset to a certain extent. Therefore, we gain more diversification benefits when the assets are negatively correlated. Ideally, we should buy negatively correlated assets or asset classes. For instance, bonds have shown some negative correlation with stocks during certain periods in various markets. However, in practice, it is hard to find investments that are always negatively correlated. Even bonds have shown positive correlations with stocks during certain periods and in recent years. The best we can do is to diversify our investments across multiple assets or asset classes that are least positively correlated. One common misconception of investing is the more stocks, the merrier. But we often gain no additional diversification benefits by having beyond 30 stocks in our equity portfolio. Diversification is thus not about including as many assets or asset classes as possible. It is about reducing the correlation between assets or asset classes in our portfolio. In reality, it can be expensive for an investor to buy multiple stock counters. One way to diversify is to buy a passive index fund that tracks the performance of a market. In Singapore, the Straits Times Index, or STI, which comprises 30 companies, tracks the performance of the Singapore economy. An investor who has stayed invested in the STI since inception till December 2015 would have seen $10,000 grow to more than $19,000. To invest in the STI, you may buy the SPDR STI ETF or the Nikko AM STI ETF. Both are listed on the Singapore Exchange or SGX and can be traded by retail investors at a relatively low transaction cost. Next up, let's explore bonds that can be found in the financial market.